Hi guys, in today's video I'll talk about different types of trading orders, how they work, have a look at the trading platform and show you how to submit an order. Let's get into it. A trading order is an instruction given to your broker telling him to buy or sell a certain security at a certain price, quantity and time. There are different types of trading orders, ranging from simple ones to complex ones used by sophisticated players on the market, such as high-frequency trading firms. In the recent history, there was an increase in the complexity and the types of these new orders. And I believe it's important to understand why this happened. To do that, let's have a short look in the history. Short history excursion. Up till 2002, in US, there are two main stock exchanges, the New York Stock Exchange and the Nasdaq. And 85% of all trades happened on them, with some human being processing every single order. No stock traded on both exchanges. In 2005, the public exchanges shifted from being utilities kind of companies owned by their members to public corporations. And by the early 2008, there were as much as 13 different exchanges being public corporations running for profit. All of the shares traded on all of these exchanges simultaneously. In addition to that, the idea that the human is needed between the investor and the market is now dead. By now you can submit an order via your computer, which gets then wired to the stock exchange matching engine, and the trade happens electronically for you. So what triggered this wave of new complex trading orders? Well, in short, it was caused by two factors. One was the increased number of stock exchanges and their system of fees and kickbacks. And two was the growing activity of high-frequency trading. At the moment, there are over 100 of these types of new orders, and each one of them is very complicated with more than 20 pages of documentation. For a regular investor, this order should not be the ones that you should be focusing on. You should have a look at the simple ones, the old ones, the straightforward ones, the so-called bread and butter of trading. And these are the market order and the limit order. The market order enables you to buy a security at the market price, buy or sell a security at the market price. You buy securities at the offered price or the ask price, and you sell securities at or near the posted bid price. Have you noticed how I say near the posted bid price? This is because you cannot guarantee that your trade will happen at the latest price. This type of order always has the risk that the market will move between the time you submit the order and the time it reaches the market. But there are not only bad things about this order. The advantages of this order is that you buy or sell a security without delay. You are guaranteed to get your trade executed. You just don't know at what price. But hey, it's not that bad. In a liquid market where you have a lot of buyers and sellers, the price where your trade is going to get executed is very close to the posted price. The other type of order is the limit order. This allows the investor to specify a certain price they would like to purchase or sell a security for. This order will not be executed if the price is not reaching the predefined level. These are the basic types of trading orders. If we add a time component to them, then there will be a little bit of variation here, but let's have a look at that into the trading platform. Alright, so we're in the trading platform. Most of the platforms will look similar to each other, so it will not be a huge difference. Here we see like a general view on the market. Then we have some stocks to watch, some currency information, some futures, some news, so it's more or less the same. And what we're looking for here is a search button or search bar. In this case we have a search bar, and I'm gonna quickly check Apple stock. So once we search for Apple, we will see a number of search results here, and they indicate the various places where you can buy Apple security. And the first information here indicates the exchange where this stock is traded. Then we have the ticker. This is like a small code for the share, and the ISIN. This is unique identification number for the security. And lastly, the currency. And you can see here that there are a number of stocks returned. If you just type in there Apple, you will see even different companies. For example, this one, Apple Hospitality Rate. This for sure has nothing to do with Apple, the computer manufacturing and software manufacturing company. So in order to make sure that you're not buying something different, it's better to check the ISIN. There were actually cases, and even recently, with the hype for Zoom, the company producing the video conferencing software, where investors were actually buying the wrong stock. In order to avoid such situations, I recommend to look at the ISIN code. And if you get the ISIN right, then you can be sure that you are buying the right thing. Alright, so let's select the Apple share traded on the Frankfurt Stock Exchange right here. And once we click on it, we can see the price evolution, the current price. And on the right hand side, we have two buttons: to buy or sell the stock. Pressing one of the buttons reveals more options to us. In this area here, we can select the type of order that we want to submit. Next to it, we can insert some price information related to the type of order. In the following area here, we can insert the number of pieces we would like to purchase, and then we get an estimation of how much that would cost on the right side. And in the area below, we can set up the time the order should be valid for. We can choose between an order that is valid until the end of the day or an order unrestricted from time perspective. It will be valid until we actually decide to cancel it or until it's executed. Going back to the type of orders, since this is the topic of the video, we can see the limit order and the market order. These are the types of orders that I already covered at the beginning of the video. As mentioned before, the limit order requires the input of a limit price, while if we select the market order, there is no price information required to be specified, just the amount, the number of shares that we would like to purchase. If we add a time component to them, then we come up to the following orders: the stop loss order and the stop limit order. The stop loss order is dormant until a certain price is reached, at which it activates and becomes a market order. For example, in the case of the sale of an Apple share, if we set up the stop price at 200 euros, then Apple share would be sold if the price drops below 200 euros. This limits the loss one could incur if the share price continues falling. If we select the stop limit order, then we get two input areas for the price information. We need to input the stop price as well as the limit price, hence the name of this order. The stop price is activating the sell order, while the limit price gives instruction to only execute at this price or better. So let's get back again to the Apple share example and insert a stop price of 200 euros and the limit price of 150 euros. And let's also input the number of shares we intend to sell. So let's say here 20 shares. The order does the following: as soon as the price drops below 200 euros, but it's still above 150 euros, the limit price, then this order will be executed. If the share price drops rapidly to 100 euros, or the market is opening next day at 100 euros per share for Apple because there were some bad news in the press, then this order will not be executed since the market price is below the limit price. This stop limit order guarantees a minimum price of 150 euros but does not guarantee the execution, while the stop loss order can guarantee the execution but not the price. The stop limit order can be useful in case of very volatile securities. If a security jumps up or drops frequently and you can rely that it can come back up in a number of months or a year, then you can set up a stop limit order so that you don't accidentally sell at a price that is in your disadvantage. Here in the section of types of trading orders, you can also see an order called trailing stop. To be honest, I haven't really used this type of order, But this is also similar to the stop loss order, being designed to protect the gains of the investor by enabling the order to stay open as long as the price is moving in the investor's favor. What do I mean by that? So for a long position, buying and holding a security, the trading stop order will be fulfilled if the price changes the direction, it starts dropping, and it falls by a specified percentage, let's say 10%. In our example with Apple, if the share price is at 200 euros and it falls by 10% to 180, then the order will be executed. Or if the price continues climbing to 1000 euros per share, then from this level, if the price drops by 10% or more to 800 euros or less, the order will again be executed. You kind of like protect the gains you accumulate through time by not selling in case the price is moving in the direction you wanted it, and when it's reverting, then you will be selling with a 10% loss from the best achieved price. This strategy can also be achieved with a stop loss order, but you always have to actively manage your stop loss orders. Let's say in the example that I gave with a stop loss order at 200 euros and the price is climbing to 500 euros, then you'll have to update your stop loss order to 450. And if the price continues to climb up, let's say to 1000 euros, then you again will have to update the stop loss order price to 900 euros so that you achieve the same result. This way you can replicate the trading stop order with some manual effort. So this was it for now with regards to the types of trading orders. So thank you guys for watching. I hope you enjoyed this type of tutorial video. If you have any questions, just drop them down below and see you in the next one.